the reason other countries are moving away from using the dollar for trade and for reserve assets is that we've been abusing the privilege of having the world's reserve currency for a really long time now, and it's getting worse. If anybody steps out of line, we threaten to kick them out of the SWIFT international bank settlement system, or we sanction their products, whatever they're trying to sell, make it harder for them to operate globally. And we do that without regard, apparently, for how it makes these other countries feel. A lot of countries would just like to be out from under dollar hegemony. And these are all trends that are in place, and they're all bad for the dollar going forward. And they won't be fixed by the U.S. treating countries who want to trade in their own currencies like criminals. So,
in today's market recap, silver price retreats from $26.80 amid uncertainty in the non-farm payrolls. Silver price drops from $26.80 as U.S. dollar bond yields rebound due to the U.S. employment data. The U.S. employment data will influence speculation for Fed rate cuts in June. The Fed is still confident of rate cuts this year, despite progress in disinflation has stalled. Silver price falls back sharply to $26.20 while attempting to recapture the crucial resistance of $27. The white metal faces pressure as the U.S. dollar and bond yields attempt to recover amid uncertainty ahead of the United States non-farm payrolls and the ISM Services PMI data for April. Investors will keenly focus on the U.S. average hourly earnings data. The annual average hourly earnings are expected to have grown at a slower pace of 4.0% from 4.1% in March, with steady 0.3% growth on a month-on-month basis. The U.S. dollar index rebounds to 105.75, and 10-year U.S. Treasury yields edge up to 4.61. The U.S. dollar and bond yields tumbled on Wednesday after less hawkish interest rate guidance from the Federal Reserve than feared. The Fed remains optimistic over eventual rate cuts this year, despite risk of a slowdown in the disinflation process. Now, we'll show you the best clips of the latest interview, but first, subscribe and turn on notifications so you do not miss out our daily videos. Enjoy the episode.
Lots of gold, which is what's happening right now. Foreign central banks are massive buyers of gold. In the last couple of years, they bought 1,000 tons of gold in each of the past 2 years. And the more gold they own, the better able they are to back their currencies with gold, if that's what it comes to. So they're gaining tools that allow them to bypass the dollar. And it's not something they can just flip a switch with or anything. They can't just do it today, but they can move in that direction a little bit at a time. And the reason it's gold that they're buying and not, Bitcoin or oil or other things like that is that gold is the form of money that traditionally backed currencies back when we had legitimate currencies instead of just these fiat things that are backed by nothing. And gold is neutral. You can use gold to back your currency without making a political statement, without choosing sides in the world's geopolitical turmoils. But with the dollar, you're kind of choosing sides now. The U.S. has taken its currency from a neutral reserve asset, where it is just what it is, and you don't have to choose sides by buying dollars. And they turned it into something where, you're for us or you're against us when you manage your foreign exchange reserves. And, nobody wants to be put in that position. And nobody, a growing number of countries don't really want to be on our side on a lot of big global issues. So that's why China, Russia, India, and a lot of other countries are building up such big gold reserves now, and they're continuing to buy. And that basically means two things. It means, one, there's a lot of upward price pressure on gold now because you got these whales in the market that didn't used to be there, but they're continuously buying gold, and they're not very price sensitive. They just, they want it for the long term. So they're not going to sell. If gold goes up $100 an ounce, you're not going to see China dump a bunch of their gold and book a short-term profit or anything. These are very strong hands where gold is going. And then at the same time, that gives them a growing ability to back their currency with gold if they want to. And that's not an anti-U.S. statement as much as it is a statement of neutrality. In other words, okay, our currency is now backed by gold, so we're not on anybody's side. We're just trying to manage our currency, so leave us alone.
Yeah.
We've got this currency that we all understand that's backed by gold, it holds its value, and we use it to trade with each other. So China's kind of signaling that that is now a prospect. And it is. It's not a short-term prospect, but it's one of those things that's out there on the horizon that will happen when it's a completely doable thing, or the U.S. forces other countries into it.
In the continuation of the episode, John Rubino highlights the enduring stability of gold as a form of money amidst currency turmoil. He underscores concerns over potential penalties for nations shifting away from the U.S. dollar, indicating apprehension about its possible collapse due to misuse as the world's reserve currency. Rubino emphasizes the trend of countries diversifying their reserves away from the dollar, driven by a desire for stability amid its abuse. Against this backdrop, gold emerges as a steadfast hedge against financial uncertainties, reaffirming its status as a symbol of wealth preservation and stability in an ever-evolving monetary landscape. Now we'll show you more clips of the latest interview. If you want to see the whole piece, check our links in the description, but first hit the like button, smash that subscribe button, and make sure you turn on notifications so you do not miss out on our daily videos. Let's get back into the episode.
Taken on so much debt over the last 20 years that we're in a place now where inflation is rising and interest rates are rising. So if the Fed addresses inflation by raising interest rates even further from here, it bankrupts a big chunk of the global speculating community, which is to say most of the world now. In other words, housing and commercial real estate and local banks, they're all potentially blown up by higher interest rates. But if the Fed addresses the effects of higher interest rates by pushing interest rates down, then it's going to cause inflation to start rising at an even faster rate than it's been rising lately. And that's devastating for a financialized economy. So we're at the point now that seemed like it was going to come a lot sooner. You know, I literally expected 2008 or so to be basically the end of the fiat currency experiment. And that didn't happen. We were able to buy ourselves another decade by taking on immense amounts of new debt. But finally, those debts are starting to bite in ways that we don't have any answer for. So I think, you know, Japan might go first because they've got so much government debt that they can't let their interest rates go up. At the same time, the yen is plunging, even versus the dollar, but also in terms of purchasing power. And so they're stuck too. So I think the story of the next few years is going to be central banks having to make decisions about which kind of crisis they're going to bring on by trying to fix other problems. And there's not going to be a solution for it. So at some point, you know, now I'm not going to name a date here, but at some point, it dawns on the world that the central banks, with their fiat currencies, just can't fix the problems that are mounting out there. And then I think the markets react by front running, for instance, higher inflation. And that is basically the end game for these currencies. And it's going to continue to move in the direction that hurts the dollar's exchange rate and its use as a trade currency and its use as a reserve asset. You know, it's going in a negative direction for the dollar, and we're not doing anything to fix that makes any sense right now. In the world, even if we cause the trouble, capital flows into the U.S. and it keeps the dollar strong relative to other currencies. But relative to other currencies isn't really the best way to measure the strength of a currency. You should look at the purchasing power of that currency, right? I mean, the US dollar lost almost 10% of its purchasing power in 2022. It was like 8.75% official, and the real number was probably more like 15%. So if all the world's fiat currencies are falling because they're all mismanaged, because it's a flawed concept to begin with, and one currency is falling a little more slowly than the other currencies, it looks like it's strong, but only if you compare it to a bunch of other crappy fiat currencies that are falling in value. So
What do you think of the current gold situation? Is John spot on in today's episode? Share your honest opinion in the comments down below. Share this video with a silver bug and watch this video right here because you'll love it. I see you on the other side.